Welcome to the 3-Edge Weekend Review for the week of September 23rd. I'm Fritz, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, the CEO and Chief Investment Officer here at 3-Edge Asset Management. Today, Steve and I will discuss how now that the Fed has moved to begin to lower short-term interest rates, and with continued progress on reducing inflation, combined with a still healthy U.S. labor market and economy, it seems as though the promise of a soft landing is alive and well, at least on Wall Street. And we'll delve into whether markets are poised for a market melt-up or not, and what risks might be lurking behind the current stock market enthusiasm. In markets this past week, U.S. stocks continued to add to the gains from the prior week, the S&P hitting its 42nd record high close of the year, after recently breaking above the previous high, which was set in July. There was also big news out of China this week as they introduced a series of aggressive stimulus measures to boost the struggling Chinese economy. China's Shanghai Shenzhen 300 index gained approximately 15% this week, its strongest week of performance since 2008. Meanwhile, the price of gold continued to rip higher this week, setting a series of record highs as investors have seemed to become more confident that the Fed will continue to reduce short-term interest rates throughout the remainder of 2024. So, Steve, I have a quote from a Wall Street trader this week who said, "Central banks are cutting and the economic fundamentals remain strong." And clearly, markets have responded really quite positively to the Fed's 50 basis point rate cut. And stocks seem like they want to go higher, and it feels like maybe they're going to continue to do so. And maybe we'll have this market melt up. So I think to start, why don't you tell us what a market melt up is? Like literally, how do you define a market melt up?
So a market melt up is a term that was created to describe what often happens at the end of a very long stock market rally that might have gone on for many years. And while some rallies end in a whimper, there are notable bull markets that we've had in history that have ended with a real surge. And often the market melt-up is driven by psychology and enthusiasm. It's driven by FOMO, the fear of missing out. It can be driven by short covering, investors who are negative on the market realizing it's going the other way, and then they buy back their stocks, and that helps cause prices to go higher. And also greed. And they're not influenced at the end of these long rallies by value. Valuation is not something that people, seem to be focused on. It's more what's happening in the short term, what's the trend, and which way is this going. Also, during long stock market rallies, the sharpest gains are often at the beginning of the rally and at the very end of the rally. So the market melt-up is a time when prices can go up quite a bit higher and more steeply and for longer than most people might expect before the inevitable correction. Once Alan Greenspan famously said that it's really hard to tell when you're in a market melt-up or a bubble, I think he used the term bubble, until after it burst. Now, here's some examples of famous market melt-ups or stock market bubbles. Certainly in 1999 and early 2000, we had the tech stock bubble. And those stocks melted up tremendously, just soaring in value right up to the end till they peaked. In Japan, we had the famous Japanese stock market bubble, which just went up exponentially at the end, right into late 1989 to the first 1989 to the first day of 1990. And then, of course, the famous roaring 1920s period that had a fantastic climb right at the end, right before the crash of 1929. Now, these stock market melt-up periods all have some common features. One is that all three of them I mentioned were among the most overvalued markets in the last century. They were the most overvalued markets. Another common feature is that they all fell from peak to trough over 80%. The tech stocks fell over 80%. From 2000 to 2002, Japanese stocks fell over 80% after the peak in the first trading day of 1990. And we know the Dow Jones Industrial Average fell over 80%, starting with the stock market crash in 1929 and bottoming in the middle of 1932. Unfortunately, the markets today, by many measures, are as overvalued as those three periods. But that doesn't mean we can't have a big market melt-up. Now, one last thing I'll mention, that while Greenspan says it's really hard to tell you're in a bubble till after it's burst, true fact, over the last 2 years, earnings per share of the S&P 500 index have grown 5.5%. The sales revenues of the S&P 500 have grown 17%. We know that over any long period of time, the price per share, the sales per share, and the earnings per share all grow almost exactly the same rate. Well, given what I just said about the earnings and sales per share over the last 2 years, 5.5% and 17%, the price per share of the S&P 500 index over the last 2 years has grown over 60%. That tells you something is really out of adjustment, and it's living on borrowed time.
Okay, so I guess the big question here then is whether is a market melt-up indeed what's in store for U.S. equities from here? As we, approach the end of the third quarter, we have the presidential election coming just a little bit more than a month away. So, do you think that's what we're going to experience from here?
Well, typically, when there's an election coming up, and when it's considered a very close election, there's a lot of uncertainty, and markets hate uncertainty. So typically, during the few weeks before an election, the market often stalls out. And then after the election, no matter who wins, that uncertainty goes away, and then the markets have a relief rally. This might be a bit different because here we are a few weeks before the election, but we've had two major stimulus programs come out, one from the US and one from China. And so this market melt-up that we contend has already been happening, could continue with another rocket boost right at this period, right up until the election. And then we'll have to see after that. But I could say that with the action that the Fed made, the half-point cut, and the action that China recently made with some pretty strong monetary and fiscal stimulus, it increases the odds of a continued melt-up, for at least in the short term.
All right. So, as always, my final question then is, if there is a possibility that this market melt-up continues from here, and even though you have these, certain risks, including the fact that the market is just so overvalued, what do you think investors should do in terms of positioning or repositioning their investment portfolios now, if anything?
So because the market melt-up is serious and can produce some of the strongest gains during a rally, and because our model is suggesting that while the longer-term factors are extremely negative, the short-term factors are quite positive for now, we would advocate holding your equity position, or if it's a little bit overly defensive, even consider very selectively increasing equities. We would not in any way advocate a full equity allocation at this time, because the danger is that with a catalyst coming out of the blue, an overvalued market can correct very sharply. But right now, as long as our short-term factors remain strong, we would advocate holding or even considering a slight increase in certain pockets of the equity markets. Having said that, we know that it's very important when you're in an overvalued market to have your eye on the exit door, because it just takes a few bad days to wipe out years of gains during the rally. And we are in a very overvalued market. So we are watching those short-term factors very, very carefully. And when they turn off, all we're left with some highly negative longer-term factors. We will act to reduce that equity position. Meanwhile, for some time, you and I have been recommending gold, tips, and short-term treasuries. They've all acted as hedges during this period, not just hedging the potential for an equity market decline, but actually making money. Gold is a great example. And tips have outperformed long-term treasuries, which have actually stalled out since the rate cut. You've noticed that yields haven't kept declining, but they've actually ticked up a bit. So that's how we would be positioned right now.
Excellent. Great. All right, Steve. Clearly a lot going on as we head into the fourth quarter and the uncertainty of the presidential election in early November. So we intend to work hard to keep our listeners informed about what is going on in the global capital markets through all of this. So that will do it for Steve and for me this week. As a reminder, all our videos are always available on our 3Edge YouTube channel. If you know someone who you think might benefit or enjoy the videos, please feel free to share them. And in addition, if you enjoy our videos, please feel free to subscribe to our 3Edge YouTube channel. We would be most appreciative. So, until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.